Good evening. Welcome to another edition of the ShadowTrader Video Weekly for Sunday, July 19th, 2020. I'm your host, Peter Resnicek from ShadowTrader.net. If you traded the markets actively this past week, you know that it was quite a difficult environment to maneuver in. There were a lot of false starts in the market. And that's why I named this video specifically, How to Change Your Mind Quickly and Often, because that was really a skill that you needed to have this week in order to navigate the market successfully and not lose money. And that's exactly what I was doing in my weekly options advisory with my subscribers in real time via text message. Now, it would be one thing to just show you a video of certain market profile dynamics, nuances, and chart patterns, etc., and just sort of Monday morning quarterback and tell you, look, here's what happened here, and this is why we turned and whatever. Anybody could really do that after the fact. But this video is going to be different because I'm going to show you a number of the text messages that I sent to my followers in real time, showing you the exact moments and times when I was changing my mind, flipping my bias from bearish to bullish, bearish, etc., and what trades I put on at that exact moment. But more importantly, going over the exact nuances and patterns and what was going on dynamically in the market at those turning points that made me change my bias on the fly, and hopefully you can learn these techniques yourself. When we wrap that up, we're then going to take a look forward because interestingly enough, if you recall last week's video, I said something big is going to happen because we were moving out of a 5-day balance area. Now we're once again potentially moving out of a balance area, a little bit shorter in duration this week. So I'm going to show you the exact breakout levels on the upside and downside that will potentially be in play for next week's trade. Okay, without further ado, let's get into it. Okay, let us begin. What, where, why, or when will all be explained like instructions to a game. I think we could do this entire video, or at least 99% of it, just using the market profile charts to illustrate what I want to talk about in terms of the very choppy week that we had, how I navigated it, and why that was important to stay nimble and avoid losses in this particular week. And I'm going to go over some trades that I shared with my weekly options advisory and show you exactly how we did just that. But before we get into the week that just ended, let's talk a little bit about the week before. If you recall, the title of last week's video was Something Big is About to Happen. And it really turned out to be kind of a dud because it didn't happen. But the big thing that was supposed to happen was supposed to be a breakout from this 5-day balance area. This was a very, very large balance area. The market was wild, and it was defined basically by highs that were relatively equal and lows that were relatively equal. And that's why in last week's video, I said something big is about to happen. As we started the week that just ended, that big thing looked like it was about to happen, looked like, it was going to happen right on time on Monday morning. See this little green dot here? I'll make it a little bit bigger so you can see it. On Monday morning, the ES opened here, outside of the 5-day balance, 31.9950 or whatever that is, right around 3,200. So the big thing was happening. We had a breakout. And for a little while, everything was fine. Everything was bullish. And I and my subscribers came into this market long a little bit of SPY options, call options on the SPY. Bullish bet, very, very small size. I called it as like a 1-unit trade because I'm generally the type of trader that likes confirmation and likes to see that things are already happening, and I like to just make the meat of the move and get on the train when I'm sure that it's already left the station. But I thought it was good risk reward, seeing that there was a 5-day balance, the market fell bullish. So I said, you know what, going out Friday afternoon, this is like an entire, before this whole week, so 7 or 8 days ago, I said we should probably have at least a little bit of SPY vertical on to take us into next week. And for a little bit of time, that was the right thing to do because on Monday, as you can see, we opened up here, but then we started failing. And when we started failing, what was very important about Monday is that we started to fail back inside of the balance area. Remember that this area here is the top of the 5-day range, and that's very, very important. So this also speaks to a number of things because it speaks to something that I teach in the pre-market perspective all the time called balance rules, which tells us that a market can only do a finite number of things when it encounters a balance and it leaves the balance, it's either going to look above and go, it's going to look above and fail, or it's going to remain in balance. And the way the balance rules work is that if the market essentially, as it did here on Monday, looks above and fails, then it automatically targets the lower end of the balance, which is all the way down here. It's basically the balance area low of the 5-day balance. So remember that, because we're going to talk about it further in a second. So as Monday started to fail, and it was kind of late in the day, as you can see, it was M period. These periods are every 30 minutes in the profile, and they are labeled starting with the letter B and going all the way out to the letter N, and then there's a little short period of O, which is the last 15 minutes. It's like a half period. So late in the day, the market falls apart, and it starts to break, and it starts, giving at least, starts to move below the balance area high. But it started actually even before that. You can see the single prints here, and the M period starts falling apart about here. So this video is all about, as I said, keep it nimble, right? Or be nimble, how to change your mind quickly and often, right? So notice that I want to show you something. When I saw this happening as it was falling apart, and you can check the timestamps here, I get out of the SPY vertical very quickly, both in my own accounts and as you can see with my subscribers. I send out these texts in real time and I say, we don't want to be in this SPY vertical anymore. And there's reason for that. It has nothing to do with price. It has everything to do with price relative to other prices, from the prior week of how the market's acting. Think about it. If the market had a 5-day balance and it's really about to go, okay, and it breaks out of that balance, not only should the market not come back into the 5-day balance at all, but you should expect that that day should really be a trending day, because those 5 days built up an inordinate amount of pressure. But it didn't happen that way. We started to fall apart. So as we started to fall apart, in the spirit of being nimble and changing my mind quickly, which I do all the time, I'm never married to any idea. I'm ready to drop anything at the, immediately and go with the other direction. We get out of the SPY vertical, and we actually even make a small gain out of it, which is nice. Where I believe a lot of people probably held longs too long and let the market fall apart. So we get out of that, and then we get into a new trade, which is more bearish, and we go with long volatility. All right, and I immediately, as a couple minutes later, I say, you know what? We're going to buy a UVXY vertical, 31.35, UVXY vertical, and at the same time, we're going to sell some UVXY puts to make this cheaper. And notice we're going to take the vertical out to August 20th. It's going to give us a little bit of time, because maybe with this look above and fail, the market might have the propensity to move lower for a longer time. Remember, I don't know that at the time, but I'm setting up the trade to give myself the runway to do so, where I buy the long vertical a little bit further out, and I can always sell shorter dated options against it. Okay? So that's Monday. And if we go back here, as we close on Monday, everything's hunky-dory. We got out of the longs, and we get into some long volatility. And we close relatively close to the low on Monday, and seems like it was the right thing to do. And then comes Tuesday, and we open lower on Tuesday. Again, everything's good. But here's where things start getting interesting. Remember what I said earlier when I said if the market has a look above and fail according to balance rules, what should it do? It should rotate to the other end of balance, basically. So it would do something like this. Here's our balance area. It comes up, it falls back in, and then the target is a short down to the other end of balance. But here's where something very interesting happens on Tuesday. It only goes to here, even though the balance area low is all the way down here. So right away, my WWSHD detector goes off big time. A lot of people say they have like a BS detector, right? I have a WWSHD detector in my mind. That stands for when what should happen doesn't. The WWSHD. The market should have sold off all the way down to the balance area low, but it didn't. And that's a huge tell. And it's something that needs to be paid attention to. So of course, I'm paying very close attention to this. And when I see something that is happening that should happen but doesn't, it immediately alerts me, aha, maybe it's not going to follow through all the way in this direction. It's going to go into the other direction, correct? And again, staying nimble, I reverse the vertical on Tuesday of the UVXY. I dump everything and I close that out for a tiny gain. And why? Because as I see us not going down there and turning around, I say, I think the odds are only about 50-50 now that this works, and that's not good enough for me. Okay, so back to the chart. So we go down, we don't make it, and then we rally hard. And as we rally hard, here's where it also, again, gets interesting. Where do we go to? We go back to the balance area high. So we rotate actually back to the upper end of balance, which is unexpected. And we start to breach and go higher, and we actually close outside of balance. So as I see this developing, and notice that the POC is all the way up here, the most volume traded is all the way up here and not down here, right? So it didn't give us any type of trending day confirmation where we had the most contracts committed at the lower end of the range, at the upper end of the range. What do? I shift gears again and I put on a small long. Nothing major, but something that is very low cost and very low risk because the market's chopping, but obviously it's no longer short. Now we're breaking up out of balance, probably pushing the other way. I buy the 390 calls in Apple. Apple, by the way, I don't have a snapshot of it, but on this particular day, as the market was reversing back to the upside, Apple was the strongest stock on my board. So I said, okay, great. Buy a 390 call for the end of the week and sell two 400 calls for the end of the week, creating a $10 spread. That costs 76 cents, but I don't want to pay 76 cents, so I'll just sell a 362.50 put single for 76 cents. And if I look at the chart, why did I do that? And it was right here on Tuesday. Again, even the chart is confirming that this makes sense because notice we start to go inside of the prior day's range. We have a bearish candle. We go back into it. And where am I short put credit? Here, 362.50. And why is that noteworthy? Underneath the 20 MA and definitely underneath trend. So I feel safe at that. And why am I doing a 390-400? Very simply, I'm doing it here on the green bar because I know that the prior resistance was 400. So given that my structure is 1 by 2, I actually have all the way until 410 before I get into any trouble. Correct? Because if I'm long one option at 390 and I'm short two options at 400, the 410 is the option that's necessary to turn a butterfly into it, which has, or to turn it into a butterfly, I should say, which has no upside risk. Okay? And then going back to the market profile, what happens then? We carry on. That's Tuesday. And here's Wednesday, Thursday, Friday. And notice that with the gap up, volatility was killed. So it was actually a very good play to get out of the UVXY because obviously volatility was not rising anymore. I'm just looking at my market minder now. UVXY closed the end of the week under 28. So it would have gotten killed. And then what happens here in these 3 days is actually a whole lot of nothing. We basically just balance. This here on a Friday, I kind of give the market a pass because, well, it was options expiry. It was a monthly expiry, so maybe the market wasn't going to do anything. But notice here, again, moving up hard, no real follow through, and then we gap down and we have a very, very balancy day and it just kind of holds like that, okay? So this is kind of a look backwards at how I, handled the week in terms of how I was able to change my mind quickly on multiple trades, etc., and how to go about it. And because, even taking it a step further, because the market didn't really do anything, there was also a lot of active management. I didn't take snapshots of the exits of the Apple or whatever, but active management there as well on something like Apple. Like for instance, I ended up getting out of the one unit at a profit and then just letting the other one get out, let the other one expire, right? Just sort of trading it, not too aggressive, being fluid with it, taking a little bit of a profit when it's there. And it was the right thing to do because the second unit ended up going out worthless, made it relatively small gain. But again, why? Because it was a question of staying fluid with the market and trading it, basically according to what's happening, not what I think is going to happen. And as you can see here, had I not scaled out of one of the units of the apple, it would have all gone out worthless because we closed well below the 390 area. Okay, so that's just, I didn't really want to bring in the whole exit of the apple or whatever, but I'm just kind of carrying forward, showing you how I'm staying nimble because I'm letting the market tell me what's going on. I honestly cannot stress enough just how important this is. A lot of people, I think, are out there watching trading videos, learning different techniques, starting out in the game, and I think that they think that there's some sort of special holy grail to all this. There's some big secret that's just going to change your trading life. And there are a few secrets like that, but honestly, if I could point to just one, it would really be what I'm talking about in this video, about basically not being married to your position and being fluid with the market, changing your mind quickly and changing your mind often. That's really the most important thing. Remember, you will never really get hurt just by being wrong. Good traders are wrong all the time. You only get hurt when you stay wrong. And that's really when the problems occur. It's totally okay to be wrong. Just don't stay wrong. And the other thing is that a lot of people don't understand a lot of these nuances that I talk about. They don't know about look above and fail or balance rules or poor high, poor low and things like that. So they're not tipped off early enough of when things are starting to sour, right? They just think, oh, well, it could still go down or it could still go up. But, they're not paying attention to these signals. And that's why I like talking about all these nuances and sharing them with you, because I think they're so important. If I can get everybody to just react to things just that much quicker, it's amazing. Think of how much that could have done for your trading this week if potentially you had reacted to things just a little bit quicker and cut your position and reversed yourself or whatever. Now that we've looked in the past and we've discussed a couple of important factors of how to stay nimble in the market, if I can just recap, the way to really stay nimble is simply to pay attention, have an idea of what the charts are telling you should happen. And then when you see that there's any price action that doesn't confirm that, you have to take that as a red flag and you must change your mind quickly and be ready to change your mind often. And don't worry about it because there's always another trade coming down the pike. There'll always be something else. There'll be another bus coming. You can catch that one. You don't need to stay married to the same position just to kind of prove your point and saying, oh, this 5-day balance, this 5-day balance is breaking out to the upside. That means, we built up a lot of pressure here. It's got to be a break to the upside. Well, it was, and then it wasn't. So, and then eventually it went back the other way, and it did. But so you got to kind of stay fluid with it. Okay. So anyway, now that we've looked back, let's look ahead. And I'm going to leave you with some good information, I think, of how I want you guys to look at the market next week and what I think needs to be done. I think it's going to be an actually relatively easy call. It's very similar to the prior week in that instead of a 5-day balance, the market now has a 3-day balance, which is Wednesday, Thursday, Friday. I'm going to call this one a 3-day balance. And one of the reasons that I see it as a 3-day balance is because look at this overnight session high here. That's 32.33.25. And look at this regular trading hours session here, right? That's almost at the same area. And then Friday, I know it's a lot lower, but it's relatively, it's relatively close. And if you want, you could even do it like this, draw a little trend line, and that would be the long entry taking the market higher, right? And just keeping in mind that this overnight high is here in the ES, and we have to break it. Now on the downside, it's also a relatively easy call to make. And again, it's a call to make ahead of time. It doesn't mean it's going to play out this way, but I want to point something out to you. This low right here is what is known as a poor low. A poor low is a low that doesn't have excess on it. So for instance, this low here is not poor because it's got excess on it. Here's another example in the overnight. That's a regular low that has excess. You only need 2 little letters, 2 little TPOs to officially have excess. But if it's less than like 4 or so, I call it lack of material excess. But in this case, there's almost 0 excess in that the TPOs are just 1 at the bottom and there's nothing there. So what does that do really? I was saying in the pre-market perspective that I wasn't surprised at all that on Friday the market gapped up, because a very common thing to do for a market is that when it exhibits this pattern of a poor low, what happens is shorts that are pressing down into that area basically never got paid. You know that shorts got paid when they get an excess low, when it goes boom and it ends on on kind of a spike to the downside at the bottom of the distribution. So when those shorts are all pressing into that same area, I think of it as like that they're painting themselves into a corner and they're not getting anything for their activity. And a lot of times that goes hand in hand with what we call the 45-degree line. And this is not a true 45-degree line. Usually this has to be wider, but very often you might get a poor low that has a 45-degree line. And that's also a direct signal that people are basically shorting at lower and lower prices, but those lower and lower prices, since the line goes like this, have less and less value, right? So they're seeing these lower prices, but they're selling low value, which is not a good thing to do. You should be buying, an area like that where not a lot is going on, because those areas tend to reject price, right? So that's basically what happens on Thursday night. The market flies to the upside, but there's another part to the poor low that we can use in our analysis next week, and that is simply the poor lows need to be repaired. Repair is simply when you take the existing structure and you add some structure onto it, basically. So you can see this is supposed to look like a nice bell curve, but it kind of ends here. Where's the other part? It needs this. So the market likes to repair these structures and add this on, so to speak. So here is also another signal point next week that I will be looking at. If the market is weak early next week and it breaches this 31.9075, at the very least, I would be looking at that as a futures day trade short. At the very, very least. Could be a larger play, we shall see. If it goes lower and we fall back into the balance area, then honestly, I hate to say it, but I don't know what to tell you, because now we have created a 5-day balance. We went out, came back in, went out again, created a 3-day balance, and now we're back in balance. So basically that's just telling us the market is seriously waiting on more information. Next week is a big week for earnings. They're going to start heating up. We're going to hear from the likes of Microsoft, Tesla, and Twitter all in the same week. Probably, I'm sure, a lot of other names, but I pay most attention to these tech names. So the market could just be balancing ahead of all that. So we shall see. All right. So now you know kind of how to play it for next week. You know what to be looking for. You want to be looking at the 3-day high here of these 3 sessions for potential breakout. I would wait till this overnight high gets breached, so maybe over the 32.33 sends it. Or remember the poor low, which is the Thursday low in the 31.90 area. That would be a downside breakout point, at least for the short term, to repair that poor structure and potentially bring us back inside of the balance area. And that is all for this week. Thank you, as always, for spending just a little bit of your weekend with me. So just as a quick reminder, if you enjoyed some of the real-time analysis that I showed you in this video that I share with my subscribers every single day, in addition to real-time trades via text message, and you would like to participate, just join us at the link below, shadowtrader.net/options. It's the weekly options advisory, $49 a month. No contract. You can cancel anytime. Try it out. If it's not for you, that's fine. We can part as friends. It includes a lot of freebies. You get the pre-market perspective every morning and also a private webinar on Thursdays as well. Looking forward into next week. Pay attention to the short balance area that we just had. And remember, there is potential that we fall out to the downside and go back into the larger balance area. If that happens, it's anyone's guess what's happening after that. If we break out to the upside, we take out those 3 highs, then we can expect maybe the market moves forward a bit. Also keep in mind, all of this is happening in the context of earnings heating up. And we've got a lot of big tech names, as I spoke about in the video, that are going to be happening next week as well. On behalf of myself and the entire Shadow Trader team here in beautiful Philadelphia, Pennsylvania, as always, I wish you good trading and good night.